Good morning. Good morning. Good morning. Welcome. Today is Wednesday, May 7th, 2025. I am Grady on the charts, and we are looking at the NASDAQ today. Once again, let's go ahead and start with a bit of a warm up here. I didn't have a chance to warm up this morning, so you guys are going to have to try to warm up with me. Let's go ahead and hop over here to the news camera. It's not going to show it, but I know I got around the ragged rocks, the ragged rascal ran. It sounds so weird for me to say that, but around the ragged rocks, the ragged rascal ran. A big black bug bit a big black bear, and the big black bear bled black blood. Whoa. Okay, we're warming up. Can I cook a proper cup of can I cook a proper cup of coffee in a proper cup of excuse me. Excuse me. Excuse me. All right, we'll try that again. We'll try that. All right, can I cook a proper cup of coffee in a proper coffee cup? Can I cook a proper cup of coffee in a copper coffee cup? Don't doubt the doorbell. Don't differ with the doorknob. You don't know what that means. Don't doubt the doorbell. Don't differ with the doorknob. Eight gray geese in a green feeling. mm, Eight gray geese in a green field grazing. And I know you're thinking to yourself, what does that have to do with the economics for today? Well, today we have the Fed interest rate decision coming in today at 2 p.m. Eastern Standard Time, and then the Fed press conference is coming in at 2:30 p.m. and that's UCT 4. So we've got some big news coming out today, and we're going to see if that affects the markets this morning. But we're not quite sure if it will, but we'll check that out, and then we will see. We will see. We will see. We will see. All right. Sometimes you just kind of have to get that. Sometimes you just have to get loose, right? You have to loosen it up, loosen it up, loosen it up. All right. Today, what are we doing today? What are we doing today? Man, today we are really getting deep. We are really, really getting deep in our trading journey. Um, and we're going back to basics and fundamentals. Today, I'm trading in a $2,000 corporate trading account. And in the future, and because I know I have very few subscribers, and that's fine. And occasionally, people will pop in. They'll take a look at my some of my shorter content. Sometimes they'll take a look at some of my longer live streams. And in this trading space, you know what we like to see? We like to see large payouts. We like to see that, I made 15 grand yesterday. I did not make 15 grand yesterday. We like to see the posts where, I made 25,000. We see these posts every single day of the week of people making large sums of money. And I think a lot of us are attracted to the markets because we see that and we say to ourselves, man, that would really be a great life to live. I would really like to do that. I would really like to do that. I'm going to do that. That's why I'm gonna start trading so I can do that. But you know what? A lot of us as traders, a lot of people we don't really, 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 really like. We don't really like the part where we have to find out the lessons. We have to learn the lessons. The market's about to open. Is the market open? The market's about to open in 3 minutes. So I'm gonna vamp here for a second. We have to learn the lessons that they learned. We have to learn the lessons that they learned so that we can perform the way that they perform. Um, and we hear what they say all of the time. And my lesson is base hits. I hear people talk about this. Take the base hits. Take what the market offers. Be happy with that. Completely reset and completely come back in the future to add to that, to grow that account, to build that account up slowly over time. And it's one of those things where it sounds cool. It sounds cool, right? It sounds cool when you make it $200 a day. And if you're not making $200 a day, you're making nothing. Making $200 a day sounds wonderful. Right? Then you look at, those people are a little bit further down the line. They're in their chapter 10 and you're in your chapter 1, page 1, first paragraph. And they're putting up, they're making 20,000, they're showing their 200,000, they're showing their $2 million months. And you're saying to yourself, "Oh, okay. Obviously, there is a lot of space between my 200 and that 2 million. My 200 and that 200,000. There's a lot of space there. There's a lot of wiggle room. There's a lot of space for me to say, "Oh, I'm not going to go for the 2 million, but I'm going to see if I can get somewhere between the 200 and the 2 million." Right? In the trading game, I'm not trying to trading game because, there's winners and losers. In the trading game, what time is it? 9:29. We have 60 seconds before the market opens. But in the trading game, we often don't think of the negative, right? We don't think of the negative. The negative is that as we could have, um, it's not 0 to 2 million. It's negative 2 million to 2 million is really what we're dealing with. There's negative 2 million to 2 million where you owe 2 million and then you're being paid 2 million. So it's negative 2 million to 2 million. And if we only think about that positive aspect of it, then we'll lose sight of what all of the things that we're actually dealing with. Number two, base hits. Number one was base hits. And I kind of moved away from that. Well, 15 seconds before the market opens. And number one is the base hits. So over the past couple of weeks, I've really been pushing what I've been able to do extremely hard. I've been pushing it harder than my level of focus is actually allowing for and calling for. So I'm requiring market is open. I'm requiring myself to be able to pull from the market what I want to pull from it. And I've been requiring myself, I've been pressuring myself to hog tie the market the way I want to and to make it do what I want it to do. We opened up over a gap on the higher time frame. So now why am I in paper trading? I'm in paper trading because I am going through my winter season right now. I don't know if there are any Jim Rome fans, if you understand the Jim Rome fans. And there is a winter that we all go through in business because these things they have seasons, right? There's seasons. And this is a 15-second chart. This is not what I wanted. I wanted a 1 minute chart. And so right now I am going through I don't want to see that. And I'm not sure why this is here in the middle of my screen. Oh, because this is Trading View. And Trading View sometimes has features and stuff that we don't know about. And it'll just appear in the middle of the screen and it won't go away. That's fine. We'll rock with this just like this. So this is not a first presented gap. We just open and we drop down. Whatever we drop down into is not going to be on the 1 minute time frame because it's going to be over here somewhere, right? Because we're at the low of this range. On the higher time frame, if we go even just to the 5 minute chart, and we'll call up the 15-minute chart right here. This is where we are. We just really there's nothing. There's nothing now. Yeah, on the 5 minute chart, we just opened here. We put a wick down below this low. We took this low out and then we popped up right here. Okay. So if there are any, if you're a Jim Rohn fan, you know the saying, don't wish it was easier, wish you were better. All right. He has this, he says he had a saying, the if a person who wants an above average income but doesn't want to become an above average person, they'll experience nothing but pure frustration. And if you're in a situation like I am right now, I know what you're going through. You think that you've done enough. That's the problem. I think a lot of us, we think we've done enough. We think we've studied hard enough. We think we've studied long enough. You see this gap here on the 15-minute chart between these two levels, between this low and this high? I'm looking it out. We just traded right to that level, right off the open. Do I expect lower prices immediately off the open? Really? Not really. I'm just watching this because I know we opened and we went down first. Then we popped up and we took out this level. So we created a new low. Then we popped up into this gap in order to run to the consequent encroachment of that gap, right? Very, very precisely. On the 1 minute chart, there are no gaps on the 1 minute chart. So yeah, so that's the scenario that we all are finding ourselves in as we're struggling in our trading. And believe that is one of the reasons there's such a huge market for trading gurus. There's a real market for people to gravitate toward particular personalities. And I'm not saying that we shouldn't. You see how we hit that gap and rolled over? Small pre-market imbalance. We just went just above that high. I think we all need mentors. We all need people to show us what's possible. So I'm not knocking that. That is not my intention. That is not my intention whatsoever. Where is midnight open in relation to where we are now? What I am saying is that one of the things that we cannot acquire through osmosis is the level of intensity and work that's truly required. We can't really see it on screen. I mean, if we copied somebody else's trades or we took someone else's signals, it is not possible for us to what the way that we would have to free ourselves from that is we would have to turn it off and then we would have to get in front of the charts alone, right? And we would have to sit in front of the chart alone. And sometimes trading is lonely, but we would have to sit here alone and we would have to go through all of those thought processes and all of those emotions and all of that stuff. Not in an effort to become a guru. Look at this level as we drop down past all of this. I see this imbalance on the 5 second chart. I see how we passed this up close candle on the 15 after we traded into that gap. Trading to a 15-minute gap right off the open, a pre-market 15-minute gap right off the open is not the norm. That's not something I would normally look for. Because that would mean that price is going to have a very aggressive and a nice ranging movement if that is the case. That's crazy. Something is different here. I know what it is. It's this. There we go. One of the things that I'm thinking of every time I get in front of the charts is this strange back and forth liquidity. Okay, go for it. The strange back and forth liquidity uses before it delivers. And I just find it is extremely we're at the low of an hourly gap. I know I have the 5 minute chart here. I'm gonna show you the hour. This is what we look like on the hour. I have some of these levels marked up um from pre-market trading. I've traded a little bit um overnight session. And that's one of those things that I was really saying that I found interesting is how, let's see, this is where we are here. We're watching to see if we get down through this down close candle. On the higher time frame, we have this level that could serve as a bullish order block, or probably, this area that did serve as a bullish order block here. It did serve. Now that we've come back in and we're approaching this level again, we're going to see whether or not it decides to serve again or whether or not it passed off the responsibility to this candle to serve as bullish order block. How would it pass off? Well, if we were moving up and we have this imbalance, this candle drops in and touches this candle. Then as we move up, create an imbalance in this range. Then this candle becomes the lowest down close candle after this move up. And then when we drop down into it, this candle serves. Then as we move up, this candle after the gap serves until market structure shift here. We move up. This candle begins to serve as an order block, right? Then we move down, back up. Then we trade near, well, these are 1, 2, 3 unbroken up close candles. We'll take that low, pull it across. This area has served, this is the hour of the candle. This area served as the bearish order block. Then price turns over and drops back in. Now, will price go ahead and penetrate through all of this, through this cluster of down close candles to move lower? Or will this process where this up close candle, this grouping of up close candles inside of this gap and this wick inside this gap and along with these up close candles sends prices beyond these two relative equal lows, right? So we have these two relative equal lows. Now it doesn't have to be so aggressive. We drop that like that, right? And then I think I'll pull that forward. And if these are relative equal lows, and if price does get past this down close candle, mean threshold plus OB, okay? So we have the mean threshold here. Make sure that's sent to the back. Visual order sent to back. All right, so um, yeah, excuse me. Now, um, sometimes I say to myself, "Oh, okay, use the entire range." Sometimes I'm thinking to myself, "Use the entire range." And this is a rule that you'll have to work out for yourself to use this entire range from this high to this low because it's unbroken as the order block. However, sometimes some in my past experience, in my experience, I have experienced that we would dump all the way through this level and we will go down to the lowest time frame down close candle, touch it, and then move, right? So we are up above the gap on the 15-minute chart. We've created this up close range. We're inside this green area, which we were using to represent the mean threshold of that down close candle or the collection of down close candles on the higher time frame. The higher time frame is this 1 hour time frame. We have 17 minutes left in it. We drop down below the mean threshold of these two down close candles. Why are we using this candle? Because, sorry, I thought I locked in. Because this down close candle served initially. There's an imbalance. We came back in, served, moved up, dropped back in, relatively equal close. This area served. Then we moved away from it with a gap. Now we've traded all the way back in. This area has an opportunity now to serve as the bullish order block. So we're watching to see whether it serves or whether or not it does not serve. On the 1 minute though, as we've opened, it's 9:42 a.m. This is our first presented gap. You notice that I did not call it first presented fair value. And the reason is because it can have siblings. It can have siblings that would that it could have siblings that could accompany it. So it could be an inversion gap, but that would mean that it would be a BISI with a SIBI And that Bissy and that Sibby would throw Price back and forth like two kids playing in the playground. And then they would then lose the ball would roll into the street, and either it's going to go up the street or down the street. But we don't know. We do know which way the ball is going to roll when the Bissy and the Sibby is passing Price back and forth. We do know. Does this guy know? Does Grady know? Right? So we do know. How do we know that? How do we know that we do know? Because of so many traders who trade with the first presented fair value gap and these strategies, who take these trades and are profitable with them. We moved down, we moved up, we moved down, we moved up away, and then this is first presented. And I think that's important for us to make that distinction because my profitability issues have nothing to do with the strategy that I'm trading. What my profitability issues have to do with are this. When I see particular scenarios playing out, am I, see this up close candle on the 15-minute chart? This wick traded into this SIBI. We broke down, created an imbalance. We have 5 seconds left in this 15-minute chart. We traded up and basically closed this gap, placed a wick inside of this 15-minute up close candle. But we're above that consequent encroachment of the gap. Being above the consequent encroachment of the gap is very, very, very important right now. But let's take a look at this. You see this small gap between these two? That means that I need to move this to here. It doesn't change anything really. We're still above consequent encroachment. Just wanted to make sure that we drew that one out all the way to it because it did not touch it. Because it did not connect, right? It did not overlap. That's the word I'm looking for. It did not overlap. So because we closed above consequent encroachment, one of the rules comes to mind to say, bullish, right? So it's coming to mind that we're bullish, and that's how I'm looking at it. Well, Grady, why don't you give us a definite? Why aren't you completely committed and definite with the answer? Again, this is what I'm saying. Now listen, this is what I am saying to you. We are at the consequent encroachment of that first presented gap. I am my um on a paper trading account. I've reduced it to I've reduced the margin to two, just as you would have in your any prop firm, TP. And I've taken an entry here. Now, taking an entry, it hit my entry and then it popped up. It did not go up above this level. I have my stop loss way up here. Now, I've already said that I believe that we could be bearish at this point, right? No, sorry. I said we could be bullish. That's why I took the entry because we closed above consequent encroachment. Sorry. Let's be clear. Tongue twisters, right? That's why we started with the tongue twisters, right? So we want our mouth and our brains to think the same thing. We want to see it, say it, think it, and experience it all in real time. So I don't want to think bearish, say bullish, trade bullish when I mean bearish. I want to see, say, and think what I'm seeing on the chart in real time. Okay. Doesn't seem relevant to you now, but remember, you're always dealing with personal self-talk that needs to be accurate, right? It needs to be accurate. Now, as we hit the consequent encroachment of this level and we struggle with the resistance to get through, I'm watching that resistance. I'm watching the resistance, okay? Now, this is what I'm going to do in my paper trading account that I don't do in my real account. Watch this. Boom. I just took $300. This has been the weakness of my trading strategy. That's been the weakness of my trading strategy. It sounds crazy, but I think that you guys are experiencing the same thing. Everybody, even when we're getting into these trades, everybody. Now, not everybody, right? Everybody who's making under everybody who's making under $1,000 a week. I think we are all practically in the same boat. Why? Because that means 5 days a week, you make $100 a day. That's $500. That's really good money. That's really good money just sitting in your computer. Not gonna lie. You make $200 a day, for 5 days a week. That's $1,000 a week. 4 grand a month. 48,000 a year. The trade that I just took is still going up. Look at that. That would have stopped me out. At 9:49, that would have stopped me out. And that's the difference between what I've been doing and getting better. So and it's easy to say now when it's not real money. So these are the types of issues that we're all going to have to work through and all going to have to deal with. Take the paper trades. Trade them aggressively. Trade them the way you want to trade them. Do what you need to do to put money into your account and then exit. So we traded into this up close candle and then we turned over and we dropped down below the mean threshold of this block of 15-minute candles. Well, where are we now? Where are we now? If we go over to the 15-minute chart, which I believe I have here, notice how we closed below mean threshold here. Then we turned over and we moved back up, hit this area, and then we turned over. So what would be the difference between the two? On the 1 minute chart, it does seem as if we close above consequent encroachment here. I don't think that that's going to be the defining factor for us today. I think the defining factor in this trade is this. In hindsight, this is the defining factor. Visual order, center back. The defining factor in this trade turned out to be the idea that we traded into the mean threshold of this up close bullish order block, bearish order block, just for this turnover and this drop down. Look at the time though, 9:50 a.m. We're coming into the macro. So it sound okay. So for low, no, that's not what I want to say. For average, okay, for the average profitable trader, for the average profitable trader, the short from the mean threshold to here is good enough to make us $1,000. Selling from here to here is $1,000. So what's the problem? What's the problem? Look at the time. Look at the time. We're still in that window of volatility that could leave us subject to and susceptible to. It's strange how I know I have this sent to the back. And every time I click anywhere on this screen, it wants to put this in the front. Here too. Guys, I want it sent to the back on every screen. Interesting. We moved down below that first presented gap, traded up to it, and now we're moving lower. Before I thought about how we just hit the consequent encroachment of that gap. First thing I thought was go short. What's the problem? The problem that I see is that we traded to the mean threshold of those two up close candles above. Then we turned over and we dropped down and we took out the lows. Now we're back into the discount of that first presented gap. And on the 5-second chart, there's an imbalance on this move down above the consequent encroachment of this first gap. I don't believe we need this hourly chart right now. We're going to go to the 5-minute. Excuse me. Beautiful. Now, there's a lot of stuff starting to develop on the screen. Excuse me. And again, we've moved back above consequent encroachment into this small SIBI. So we have the BISI and the SIBI. And we talked about this, right? We talked about these two passing price back and forth, right? And then it's ultimately going to let the ball roll into the street, and then we'll see the ball roll up the street or we'll see the ball roll down the street. But these two are going to pass the ball back and forth, back and forth, back and forth. Now we're in the city. Does it matter that the Bissy formed first? Right? Does it matter that the Bissy formed first? Buy side and balance, sell side efficiency. Does it matter? Okay. 22 is nice. Like it's fine. No background. The Bissy formed first. Does it matter? Right? Does it matter? The Bissy formed first. The buy side imbalance formed here. Sell side formed here. Does it matter? That's going to be our question. Does it matter? Does it matter? Does it matter? Green. Why did I use green? I use green because normally it's right. Green is up, red is down. Okay. So we created this area. Remember, we took our first entry here. It moved up. We got out. We got out why? Because it was $300 and it was good profit for a small account. Trying to make 10 grand off of a $2,000 account is doable for people who have made $300 consistently over a long period of time. Okay. Mm. Making $2,000 on a $2,000 account is easy for people who've taken that $300 trade on a regular basis over and over and over. I don't know. I don't know what I'm saying here. So we dropped right back in to the consequent encroachment of this buy side imbalance, sell side efficiency. We tapped off of it. There's a down close candle. We traded into its wick. Now notice how this down close candle trades right into the middle of this SIBI, but then it rejects, closes in the discount. We open a discount, put a wick down, close here, one wick off of the consequent encroachment. Now we move back to where we were when we made the exit on the initial trade. Now, the time is 9:57, which means that this is the beginning. We're in the macro already for 10 a.m. We're just moved past excuse me. We're just what's the word I'm looking for? Cracking? Nope. Nope. Hmm. We're just inside the high of us of the SIBI on the 5-minute chart to the left in the pre-market here. See, small little imbalance right here. We're just inside of that imbalance. This is the area that I wanted to hold for previously. So from the area where I entered prior to 950 here, the slight push up. This from that same area to the upside is what I was targeting. This pullback that took out these relative equal lows here. I don't know what to say about that. I don't know what to say about that. I was thinking that, business in life is like the seasons, right? Winter, spring, summer, and fall. Winter, spring, summer, and fall. After winter comes spring. You see what I'm saying? After winter comes spring. And it's always like that. And it doesn't change. It doesn't change. As we see price getting ready to move up, well, there's going to be a winter, right? And so every time we get ready to get into our trades, we have to wait for winter. We have to expect winter. We have to expect some type of a downturn, right? After opportunity comes difficulty. After the good times comes the hard times. It's just right after times of progress becomes recessions. It just happens. It's a normal thing. Okay, so now we have to remember that we're still inside of this 15-minute up close candle. Now, remember, we just dropped down, we took out these relative equal lows, and then we pressed up. What are we pressing into, right? What are we pressing into? It's 9:59, it's 10 a.m. We've just ran this level. We're inside of this pre-market imbalance. Price turns over. Question that I'm having at 10 a.m. is the pre-market imbalance that we're looking at right now. This is our silver bullet for today. That pre-market imbalance at the low of this up close candle on the 1 minute chart. It's difficult to imagine that. What do we not want to overlook? We also don't want to overlook this BISI, right? This buy side imbalance, sell side inefficiency. We still have to maintain this the first presented gap. We still have to understand and represent and we still must take into account the first presented gap. It's still here. It hasn't gone anywhere. What does it mean? Is it going to be the catalyst or involved, not catalyst, but will it still be involved in a move down or a move up? The higher time frame says, the higher time frame says we just traded into an up close candle. Inside this up close candle, what do we have? We have this small imbalance. We have this small imbalance between this up close candle, this long run of down close candles. On the 5 minute chart, we see that we have this up close push. We move in, we move up, we change market structure though. We drop down, we run out the stops below that. We move up above, we close, then we open, and then we drop away down. Now, we have to come to a conviction about what we believe price is going to do next. And that's one of the things that often we'll struggle with. It doesn't seem like it would be a thing that we would struggle with. It seems like we would say, well, what I'm going to do is I'm going to put my money out there and I'm going to gamble it and I'm going to see what happens. Oh, oh. It's not an effective way to trade. It's an effective way to earn $300 and then give it right back. Mm, 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 mm. What do we think? What do we think? We respected this busy. We dropped the wick into the busy, moved up, and began to trade sideways at 10:02 a.m. Mm. Oh, goodness. Well, I'm just holding now. So this part of the day, what do we do? This part of the day, what are you guys doing? What are you all doing? All right, what I'm going to do is a little bit of housekeeping right now. Screaming out, good morning. There we go. Okay, I'm just making notes right here. And why am I making these notes? Well, I'm making these notes. I'm making notes and I'm doing other things because right now we're in a moment of decision with the marketplace. I know we have Bissy, Sibby, Bissy, right? So I am also weighing the idea that it would be possible for us to use this as an inversion gap, which could offer multiple passes through this range before we would finally deliver. Because what we have news at 2 o'clock. So does that mean that throughout the day in the morning that we would um, have a lot of aggressive movement prior to news? Does that mean that prior to news we would have a very docile, quiet market? In the pre-market London session, let's say in the Asian session, we had a nice percentage move down. We consolidated toward the end of Asia, the beginning of London. And just prior to the open of the market, the price flushes a little bit. Does that mean we're going to have a lot of aggressive movement right now prior to the Fed rate decision? Or does that mean that we're going to wait for the Fed rate decision and then the market is going to wake up and have a lot of movement? This may be one of those days where if you made your $300 accidentally off the open, you might want to shut it down and then come back in the PM session. And so, because the morning session could just be a lot of consolidation and a lot of um, as I like to call it, accounting, where we touch every price on the screen before we decide that we wanted to go anywhere. And then if I decide to put 10 trades on throughout that entire span of time, what type of price or what type of range am I looking for? How much money am I attempting to make? Am I attempting to make $100 a trade, $50 a trade? Am I looking to scalp in and out of $20 positions? And if I did that, would it be worth it? Right? Would it be worth it? Because look, we're up $300. What could we do? We could take 3 trades for $50, $50 of risk. Um, earn one, which brings us to 350, lose two, which takes us down to 250, and then we'll have to deal with what? Well, I had $300. 5 minute chart. I know we're in this order block on the higher time frame on the 15 minute. Just want to pull this back. Then we're going to reduce the visibility on that just to hold it off for a second. And now we're looking at this small imbalance here, small little Bissy here, boom, bam, pop, how. It's gonna use the inversion gap so I could just identify how. We dropped into this Bissy, we took out the low here, we dropped in, and then we moved up. So yeah, it took us a while to get to this point. Now it's 10 a.m. And now, sorry, now it's 10:07 a.m. We know that the macro ends at 10:10. Or have we broken out? Mm. They say drink more coffee. Mm, 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 mm-mm. We haven't. We haven't quite broken out. But I do recognize that we're above mean threshold, or what we consider to be mean threshold of this 15-minute candle. And we closed here, drop back in. This is a very bullish signal. Dropping down and hitting this gap and then popping up was very aggressive. How many of us are placing our order down here in this small little gap and waiting? All right, how many of us are doing that? Now that we've moved away from this area and we haven't utilized it, I'm gonna adjust this to the last point we did utilize it, which was here. Then we dropped in here, touched the high of that gap, and then we moved back up. Remember to search for these, I'm gonna call them spots. Remember to search for these spots, everybody. These are the spots to remember to search for. Nope, nope, nope. Now, you're noticing that I'm not trading, right? You're noticing that I'm not taking more trades. I went for my ride this morning, and the first thing that I thought of is, you guessed it, A plus setups. Yep, the first thing I thought about this morning when I woke up was A plus setups. Like, how many of these trades have I taken that weren't A plus setups? That just were not. That were just, I see a spot, it's good. How many confluences are there? What is a confluence? I'm taking a trade, right? On the 5 minute chart, we just turned over on this down close candle. Price is lethargic. It's not really running anywhere. And in the last few weeks, we've seen price get places, right? So for me, because I remember this sort of reactively. Then when I see price begin to really just move at certain points in time, then I start to develop this idea, right? The idea is if price is moving rapidly, I don't want to miss it, right? So then these days come up, or not even these days. Price often rushes and runs, and we hurry up and then we stop. We hurry up and then we wait. We hurry up, then we get to a particular location, particular place, and then we just stop. I just wanted to see where we are here in this 1 minute imbalance. We're at the high of that 15-minute area and just traded right up into it. Above it, excuse me, above it we have SIBI on the 1 minute in the pre-market. And forgive me, I realize now that I've left something very, very important. Now, this is the midnight open right there. Then, let's see, let's go ahead and I am looking for 5 a.m., 5:30, 5:15, 5, and 2. Here is London session low. Here is London session high from 2 a.m., 5 a.m. O B O B E G ba B ba B ba 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 boo ba B ba boo 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 ba 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 boom bum. London session. So let's lock that in. Yeah. The low of Asia is 19,976. That's not true, is it? That's not true, is it? The low of Asia is 19,976. Let's see. Let's pull that up real quick. It's just Asia's low. Higher Asia is 20,108. Grazie. Grazie. That 52. $1,000 or $1,100 that we were looking for us to move up into this area is not real. That is not real. Um, we got to get better. We've got to get better. All right, let's see. This is calendar. Look at these gaps in my calendar. Look at these gaps in my calendar. See these gaps in the calendar? Yep. Journal entry on the NQ. How many people know you can do this? Let's do this. How many people know you can do this? I'll do this and this. It's like a 15-minute chart. What am I dealing with here? Yeah, it's a 15-minute chart. Go to the 1-minute chart. Pull all this information over here. Tighten it up. Come over here. Busy formed first. Does it matter? Remember to search for these spots. I need to reduce that so I can even see the spot that I'm looking for. All right. Now, this high, this gap, this imbalance that we traded to is the difference between this low and this high. The gap that I would have drawn, right? The gap that I would have drawn was between this one and this one, not these two. The low of this up close candle is the difference between this high and that low. Control Shift S, chart image copy to the clipboard, Control V. Oh boy. Let's see, studied. You know what? You know what? We need Notion. Hey, Notion. Hey, Notion. You know what we need? We need a microphone. I need voice to text. I need voice to text here, buddy. That's what I need. That's exactly what I need. I need voice to text so I can um speak and then well maybe you know what? Maybe I'm being lazy. Maybe I'm being lazy. And then I'll just say um I just want to bring a little tiny little Notion over here so I can still watch the market. Okay. You know the caps lock on my keyboard is gets it's right there. And I cannot tell you how many times as I'm trying to type that one little puts me on that caps locks button. And then they don't offer you any opportunity to disconnect your caps lock so that, I don't mind hitting tab or shift, right? Tab and shift are fine. Just when I'm getting ready to type, everything is small case, lowercase, capital case, small case, lowercase, capital case, and then shift and caps lock are side by side. So you're trying to hit shift just for one capital letter, and then all of a sudden you hit caps lock and you're typing caps for the rest of your life. This small move down after we pressed up, man, sometimes I buy that, and then sometimes it continues, and then sometimes I buy that, and that's the reversal area. That's not what we're talking about right now. Studied, VISI and SIBI relation, um, morning of Fed rate decision. This definitely was uh cleaner price action. Um, negative. No, let's say that. So we'll just call it bullish and bearish order block. Bullish and bearish order block participation. And I'm gonna tell you, that's one of the things that I really cannot stand about the bullish and the bearish order blocks. Sometimes I feel like sometimes I we get sound like the trash man got his arm caught in the trash can. Something you out here screaming. Sometimes I feel like we get this moment in time when we're in a consolidation, and the range literally is from this order block to this order block. And what I like and dislike about those time frames, number one, the thing that I like is it's easy for me to get involved in the trade. I find myself getting in, placing my stop loss. Price begins to move almost no issue. What I can't stand is when um I need to do the quick math. 6%, 60%. You're asking me, what do you mean? So what I was wondering was on $2,000, how much is what percentage of 2,000 is $300? It's like 15%, right? Let's see. So I would do what? I would do 300 divided by 2,000, 1.5. That's 1.5. 1.5 is it's not right. Nope, that is not right because I didn't do the math right. It's 15%. Thank you. I did 15 cents. 15% the same way you would do 15 cents for 15%. And I think 15% is a better way to put it because it's just for those of us who are getting to it, we have to get to it. Now, you see this area where I said, "Oh man, you see, this is the spot where I always want to buy at, but it always seems to be the reversal position. This spot, when I first started trading as a momentum trader, and when I was trading momentum, I would find that we would that we would see the market move up and pull back, and then there'll be the pump and the pump and the pump, right? Look at how we are moving up, moving up, moving up, dumping, and then moving up, and then moving up, moving up, moving up, dumping, and then moving up. So it's like um winter, spring, summer, fall. Nope. I guess this would be fall. This would be winter. No, that's not true, right? Right. Winter would be this. The low consolidation would be winter, spring, colder than winter. Like winter, spring, summer, fall, right? So I think it'd be better for us to think about the market in that way, not to think that it would be spring, 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 right? Not spring. It's not spring, 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 spring. It's not just this up, this vertical line, this vertical line. And there some days are it's just a vertical line. But even the market, even the Fed refers to as the market being hot, as the economy being overheated. That's a terminology we use here in Texas, synonymous with the summer, to be overheated. Okay, now this trade would have stopped me out here. I would have cried and boo-hooed. This trade, this one, this spot, as we came into the SIBI, had I said, "Oh no, I was wrong." Watch this. This is the thing that I get gets me sometimes. And I'm studying live with you guys, so don't think that I'm trying to teach you. I am studying live in the market just like this because the way you practice is the way you're going to trade. I just made that up. I just made that up. I don't know if that's true. I don't know if that's true. Okay. So we had this low. We had a lower low. And we talked about how we came into this level. We hit this up close candle. We traded to the low of it. Then we went lower. We came up here, touched this level. Then we dropped in. Right. This possibly considered market structure shift. All right. Normally, we're looking higher end market structure shift, but we drop in and we do not close below this level. Close here, higher close. This close above this. Okay, so now higher close, let's say higher high than this, and then a lower high than that. This next high is higher than this. Then this low is lower than this one, but it's still not lower than this one. Then we move up and make another newer high, turn over. We go past this initial first presented gap. Then the nature of it is inversion. We completely close below it, trade into it, trade to the high of it first, turn over, drop down in, touch the consequent encroachment. Then we trade away from it. We come back in, and lo and behold, Mr. ICT doesn't seem to want to let us forget this. Lo and behold, we drop right in, and it's hard to see because for some reason I'm getting ready to make a mark here, and 8 too big, not what I'm looking for. Perfect. Right here, we hit the high of that first presented gap. Okay. And I think I'm just about done for today. But we drop right back in. We hit the high of this gap. I really want to come over here and put some pretty stars and stuff all over the screen. You know how we do. Huh? You know how we do. Especially at the end of a day like today. This is one of those days where I know that we have news and oh, the market's still moving. The trade off of the high of this first inversion. Beautiful, beautiful entry. Beautiful entry. And that is the perfect one right there. Oh yeah, that's perfect. Why is that perfect? Well, it's perfect because we made this cute little entry. Send it backward. Oh boy, oh boy, oh boy. We made this cute little entry, and that spot where we saw us drop right in, we say to ourselves, oh boy, oh boy, oh boy. And the opportunity, oh, the opportunity for the patient. The opportunity for the patient presents itself. Those who allowed this inversion to happen, ignored the initial uh, ignored this SIBI, not ignored it, but took the SIBI into account. Then let's also do this. Let's also do this. This is the last thing I'm gonna do. Then just below the high of this candle, just inside of this gap, right? You see how this wick runs past this, and this wick runs past this as well. Just right here is the entry spot, and then we pull away. One of the things that one of the things that are one of the things that's the most painful about trading, I say painful, and I do mean painful. I mean painful because if you think of it in any other way than the way that you actually feel about the market, right? You think about it in any way differently. Sorry. I love messing with the mic. I love messing with the mic. Nobody else likes does that like me. But if you think about trading the market in a way of the way that you feel, then you're going to think about the way that you're addressing the information that you're dealing with too. So instead of you saying, "Oh, this is data, raw data," you're saying this is good data or bad data. You're saying this means this or this means that, and it really doesn't mean anything because the market is creating a digital representation of a fractal price delivery model. And if for what that means to you guys, then that's exactly what that means. And so, if Price is delivering a digital representation of a fractal price delivery model, then there there is manipulation to a certain degree, but the manipulation is a part of a pre predetermined destination, a predetermined output. Because whenever we see price flash, you know what I call flash is that price will be in a consolidation, and then for a brief moment. When I say brief moment, let me be more specific. So let's say you're in a 5 minute consolidation, but you're on a 1 minute time frame. And for 4 minutes, 5 minutes, let's say 10 minutes, 15 minutes, price is going sideways. Um, as you approach the end of that consolidation, or as you approach a certain point in that consolidation, then you could see price expand rapidly. The range expands rapidly. So you're in a 20-point range, then all of a sudden there's a 30-point candle, a 30-point range candle, and it goes in one direction and it gets there in the same amount of time as, in one candle, it gets there. So you have 15 single candles inhabiting this range. And then one of these candles stretches out 30 points to a particular area. What is the thing that is the most difficult and emotional part for the human, for the trader, is to remember that that is going to a specific place, and that place is already on the chart. It's not going to create the gap or the order block or whatever it is that you're targeting afterwards. That place is already positioned on the chart. When you get there, boom. Now, I'm internalizing. So internalize as well. So I'm gonna continue to do things like this. The area of interest or PD, price delivery array. is on the chart before before what? Before mm, it's on the chart before I can't think of the words I want to use. The area of come on. The area of interest, pointer interest, or PD array is already on the chart. This draw on liquidity will be accessed before price changes. Uh-huh. That's right. Changing changes its no, not change. Because it may it because see, because change is a human thing, right? Change is a mental thing. And price is not changing its approach or changing its direction. It's not. It is those two things are the same thing. If that, can that make, does that make sense, right? Those two things are the same thing. It's not changing its mind. If it drops down to an area of interest or it drops down to a PD array, an order block or a gap prior to its move to, as ICT would call it, its terminus. It's not changing its mind, right? If does it if anybody ever let's say before it changes its direction, changes its state of delivery for everybody who's trying to keep this, trying to stay. These people worse than the Star Wars fans, right? I gotta be in line with canon. But before it changes its state of delivery, okay? But the change in the state of delivery is not separate from the point at which we see price gravitate toward initially. Even the manipulation is not different from what price is doing. The manipulation is an extension of the range of price delivery, right? It's an extension of the range of price delivery. We might enter the trade, and the trade might be 30 points, 100 points, or whatever the case may be. And it's thirty points or 100 points from low to high. We enter um 30 or 40 points from low to high. And we enter the trade at 10 points in, and we exit just prior to the 38th point, right? So it still goes up a few more handles or whatever. Let's just say whatever. That initial move in the opposite direction is an expansion of the full range. It is expansion of the full value of the range. It is not separate. So we say, oh man, it hit my stop. It ran my stop and then it went up. But when we take a look at our trade again, we'll realize it ran our stop, but our stop is inside that 80%, 87% range of the entire range. Or 70, 79, 80% range of the full range. That's where our initial entry is. Then it drops down below that. And then we'll always notice it literally goes back to our initial, it goes to back to our initial entry before it finally runs toward terminus. It goes exactly where we think it's going to go, but it comes back and it stops where it stopped us out almost, and it feels personal, like, yeah, this, you almost had me, right? But that's kind of the thing. So the area of interest and the area of interest, the point of interest or PD array is on the chart. This draw on liquidity will be accessed Sorry, I'm glad I read this. This draw on liquidity will be accessed before price changes its state of delivery. This is um and I wanted the mic I wanted to focus on me, but it always wants to focus on the microphone. I can't stand it. But then when I get the mic off screen, then I can't even hear myself properly. Stop playing with the mic. All right, sorry. All right, so what was I saying? I was saying that the area of interest, point of interest, PD array is on the chart. This draw on liquidity will be accessed uh, prior, before price changes its state of delivery. This is the completion of price delivery. DELIV. That's the completion of price delivery. First, the first press FVG. You know what? I know using the term inverted is not proper. Uh, because we want to say this is an inverted fair value gap, but it's an inversion. And what does that mean? I think it's almost like a rubber banding effect. It's like a rubber banding effect, if to be honest. As far as inversion is concerned, it's like a rubber banding effect. It's just that we have this initial gap, right? We have this initial gap, but then it's almost like halo effect, right? Like a halo that around this area from here to there, price expands in both directions like wings, right? Off of that area, and then comes back to that zone and then moves away. Because if you think about any calculation, this is the definition of standard deviation, right? That centrally, that this would be what do you call the exact middle of the standard deviation, right? So it's a bell curve. So if this were a bell curve, this would be the center of the bell curve, and then this would be, you know, some certain number of standard deviations from that area, and this is a certain number of standard deviations from this area. Boom. Then we move away. Boom. Come back in. Drop. Bang. Bop. Bow. Bang. Bang. Bop. Pow. And then we move away. Then what do we also see? Bear shorter block. I mean, bullish order block. Hate to say it, but bullish order block. And what am I looking at? This, that, or the other thing? Well, prior to this move down, these candles closed much lower than this. So all of this area, that's this overlapping candles with no movement away from that zone, I'm considering that bullish order block. We move up, we move down. This level closes below this level. Then we drop in and balance below that level, and then we move away. And I'm looking at this again and again and again and again and again. Now, you'll have to do the same thing. And then what you'll see in the future is what? In the future, you'll see that you look at it again and again and again and again and again because you don't want average outcomes. If the average person looks at it 10 times, right? We're talking about the standard deviation. We're talking about the bell curve, right? We're talking about statistically, most people are going to look at their charts on a particular, so many times, only so many times. Statistically, whatever that number is, you have to add 10, 20, 30, 40 times for yourself because you do not, we do not, I do not want average outcomes. But I'm getting average outcomes, and then I'm saying to myself, what? What is this? Why? We'll talk about that. We'll talk about why. This is why. You see the gaps on my chart? You see these gaps? These gaps aren't, these gaps are average. These gaps are average. If you aren't profitable yet, look at your journal. Look at your journal. What are you going to say? What are you going to see? What are you going to say? Oh, you're right. That's average. I'm doing the average. If the average person does just enough to get by, that's not going to work in trading. And if you're average and you're doing the average work every day, that's not going to work in trading. It's just not going to work. Sorry, it's not going to work. You're thinking, oh yeah, no. In class at school, they passed me with whatever number they gave you, right? They passed me with whatever number they gave you. Okay. All right. So, um, I know in the newer generation, the grading level is much lower than it was in the past, right? So, in our time, an A was um 90 and above. Some people said 89. Some people said 90 and above was an A. And then everything from 80 to 89 was like a B. And then everything from 70 to 79 was a C, right? Okay. And then everything below that was, D, E, F, whatever the case may be. So, um, what in trading, it's like this. It's like this. Okay. An A, an A is 95 and above. What does that mean? That means so many percent of traders fail. 90 something percent of traders fail. So an A, passing is at the very edge of performance in trading. Passing is at the very edge of performance in trading. Um, but most people's expectations of their own performance is not the very edge of anything. Most people think group thought, right? Group think. So if I'm in the middle, if I have the average behavior, if I have the whatever everybody else does behavior, then I should be safe in the herd. That means that if 98% of failure of traders fail, which means that the 97th worst trader, the worst, the trader that's 90%, that's where I feel like I am right now. I'm not gonna lie, I feel like I am the 97% worst trader. Which means what? That means that something I need to do something else to push me over that 97.99 percentile. Right? I need something to push me over that 99.9, right? Because if most traders fail, and I think I did that in reverse, right? So if 99, so yes, I think I was right. So I think where I am is I'm at 90. How do I put this? Okay, where would I want to be? So okay, I want to be in the 2%, right? I want to be in the 2%. Okay, I want to be in the 2%. So what's outside of the 2%? Right? What's outside of the 2%? I want to be in that 2% that pass that are successful, right? But then that's a completely different group in and of itself, right? Because there's a difference between profitable and doing extremely well, right? So there's a huge difference between being profitable and doing extremely well. So you have the 2%, okay, and then you have the 98%, right? Me personally, I'm at um if I'm in that, I'm in like I'm at 2.1, right? I'm in at 2.1%, right? Only 2% are successful. I'm at 2.1%, all right? And if you just do the math, I'm trying to get out of that 98%. So I'm at 98. You're right. I'm trying to get out of the 98%. And the analogy is so difficult because I don't know if I want to be 98.12. Like, what does that mean? 98% of people fail. I'm at 98.1. Does that make sense? I mean, you do yeah, let me know. Let me know. Somebody explain to me how that rationale would work. But I'm not in that 2%. Nor am I in that point that point 2%, right? That 0.5%, whatever that may be. So there are a lot of the break-even traders. I count myself among them. There are a lot of people who are taking home payouts. Okay, not among that group yet. Oh, the market just turned over and just dropped down. Considerable. And I know you're probably saying, well, that's weird, you're not trading. Well, I'm trading paper today, so it doesn't matter if I caught this trade or not. And had I taken my $300 win here in my own account, it'd have been fine. I would have turned my computer off. That's oh God. Think people. If you want to get out of that 98% and get into 2%, I do. I do what they tell us to do. Hey, when you get your money, get up, get off the chart, go do something else. Just take what you have and go somewhere. When you come back to the market and you saw that you exited with your $500 and had you held another 10 minutes and it would have been 10,000. You see the broken heart on my screen? You see this broken heart? Oh, poor you baby. Poor baby, broken heart baby. Broken heart baby. You only made $500 and 40. How long did it take me to make that $300? Oh, poor baby, you poor baby only made $300 in 30 seconds. You made $30 and your $300 in 30 seconds and shut it down? Poor baby. Baby. Oh, what? Oh, okay, yeah. I mean, we all have to watch ICT at the end of the day with his 10 contracts, letting his 10 contracts ride for 3 days. With him and his account entering 3 months ago and letting his account run for 3 straight months without exiting. But, it is what it is. I think this is gonna be my new losing trade day uh slide. Broken heart, losing trades on the marketplace. Control shift. Yes. But that's what it is, guys. And it's okay. It's okay. It's okay, guys. It's okay. Because I think that for the people who are trading, we want something different out of our work than most other people want. But you cannot expect it to be without work. It's not going to be without work. There's going to be considerable amounts of work that we're going to do, and it just is what it is. I heard a guy say, "Oh, I have the prettiest chart colors of anybody." And if you when you trade long enough, I'm about to end this stream in just a second though. But when you trade long enough, you will look at certain charts and say, "Man, this is beautiful. It's just pretty to look at." Will you be in profit though? That's the question. Will you be in profit though? Okay. Boom, 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 boom. That's nice. Heartbreaking, baby. Sometimes it's heartbreaking. All right. So I'm gonna go ahead and shut this thing down. I am still taking notes, and it seems like I'm playing. But if when your work is fun, you never work a day in your life. The first presented FVG um saw inversion as what did I say before? As price. Um, um, you spell expand. Expanded. Several handles. Is that a handle? I don't want to use that. I'm just gonna use the word points. I know what a handle is. I've read it, looked it up, but something about using it appropriately. The first bit of the SR inversion as price and commanded several points above and below before re-entering for re-entering in the, I'm not going to spell this out, consequent encroachment and continuing, continue to terminal. Let's see if there's terminus. Then that was that gap above that 15-minute level. You just trade up into it, turn right over and tanked. Tanky, 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 tanky. So we approached the order block. We approached the bullish order block, the opening at the open. We approached it at the open. Price suggested that we were going to see lower prices from a slight move to a 15-minute SIBI at the open. We moved to that 15-minute SIBI at the open. We did. We moved to that 15-minute SIBI at the open, right? We saw that. I don't need this. No, I don't need this. We saw this and we highlighted it briefly here. This one, right? Right here. We saw this 15-minute imbalance and we saw this and we said, man, look, there's an up close candle that could send price lower. We open, we run into it, and we respect it. We respect this level. How do we know we respected it? We respected it because this level sent us down to this bullish order block. The bullish order block bounces it back above the high of this up close candle. This higher time frame imbalance, touching right off of Asia's low. The science. The science! Touching right off Asia's low and then flushing for a beautiful one-way move, 140 points, 569 ticks. In how long did it take? How long has it taken us to get here? 5, 10, 15, 20, 25, 30. 30 minutes just to get to this point. Now, remember the inversion of the first presentation gap, that inversion? Similar principle here. I'm imagining, right? And a similar principle is reclaimed order block. I believe is the inversion is the sister to gap inversion, the reclaimed order block. As this gap goes forward, as we move down below it, we trade up, then we respect the mean threshold of this order block, reclaiming it. So just as we see this gap here pulled forward, all of that is in the discount. We ran up here, hit the gap, turn over, come back down into the discount. Then we pick right back up here where we left off, which is the 5-minute chart. Sorry, this is a 5-minute chart. But even there, we see the SIBI on the 5-minute. We trade up into this 5-minute SIBI, and then we continue lower. Let's see what it looks like on the 1-minute. Just for final clarification before we exit today. Nah. mean threshold of the closed candle that we pulled forward on the 15-minute chart. Initially, as the market opens, where is market open? Market open is here at 9:30. We look at this candle, we pull it forward, we move up, we move down, we move up to mean threshold. We're wondering whether or not that gap here is going to send us lower. It does momentarily as we drop down into the bullish order block to the left. That bullish order block, like a volleyball player, just pops it back up, right? What do you call it? What do you call it in volleyball? Set. It sets the ball, pops it right back to Asia's low. This is the New York open. This is the midnight New York opening price. We see Asia's low. We see that consolidation in London. All of this back and forth price action. Then we tank. We move all the way down. That order block spikes, sets the ball. Asia's low spikes it, driving us all the way back down into this area that we have considered to be a bullish order block. And it does so in a direct and one directional way. Hindsight is 2020. Hindsight sometimes is 2020. But we're gonna keep looking back. We're gonna keep studying this hindsight 2020 price action. And that's gonna be it. All right. So I hope you guys, I mean, I look, you guys are going to be the people when you see this, when you see the shift in our profitability, and you say, "How in the crap did he do that?" Then you're gonna turn everything all the way around, and you're gonna look, and you're gonna say, "Oh, it wasn't always like that." His channel is not full of fluff. This is the real stuff. This is it. This is the real stuff. And we're gonna keep going over this until in the morning, I say, yeah, we're dealing with this order block. Let's look for that spike up above these levels, and then let's see if it turns over and drops down. And we're gonna call those things in advance. You heard it here. You heard it here first. We're gonna call those things in advance. We're gonna. It didn't focus on my face. It didn't focus on my face again. I guess it didn't like my little ugly face. Hold on a second. I am live. I am live. All right. I need a moderator. Bye. What is this? Why did I put this there? What was that? Search for emotes. Oh, okay, okay. Have a great day, y'all. Hey guys, I thank you guys for stopping by. Like and subscribe. Like and subscribe. Support this channel. And I know that, I'm not gonna get and I'm not gonna speak negatively about this. I'm not gonna speak negatively about this, but I know that I'm not gonna get the type of support that I think that I really want until I can offer people um consistent consistency and profitability. Because when it comes to trading, and we're all struggling with trading, nobody really needs to, nobody, in trading, nobody wants to commiserate. In other aspects of life, people are like, yeah, buddy, woe is me too, woe is me too. But not in trading. In trading, it's almost like one of these things where we all want to gravitate toward the winner. Like we all want to sit next to Steph Curry. And if Steph Curry is shooting the shots, we all want to say, yeah, we're winning. But I'm just not that type. I want to get out here and I'll shoot my own shots. I'll take my own losses. And I hope that in the future, it'll be a point in the time where you guys can, see me drain my shots. So we're gonna get there. We're gonna get there. We're gonna get there. We're gonna get there. Let's go. All right. You guys have a great day. Like, subscribe. I'm Grady on the charts. You have a good one. Bye bye.